Hi, I'm James Robinson, and this is my stock pick of the week. I actually bought SEIC for $55.11 back on March 2nd, and I don't always have time to make a video immediately upon, and certainly not preceding a purchase. So if you want to keep up and know exactly what I'm doing when I do it in real time, I always Twitter whenever I buy or sell a stock, or tweet, I guess, whenever I buy or sell a stock. So if you want to be up to date on what I'm doing as I'm doing it, the right way to do it is not to follow these videos. The right thing to do is to follow me on Twitter, and my handle is @RobinsonStocks. Obviously, having said that, if you like this video and you want to see more, I'd appreciate if you'd follow and hit the notification bell. Liking it is great. Obviously, that helps me grow the page and will continue to encourage me. And finally, if you subscribe to me, I'm always keeping track of where my subscribers are. So just write down in the comments, hey James, thanks for the video. I'm in Stockholm, Sweden, for example. So now onto the video. So when you look here at the stock, you'll see that effectively they've gone from about 220 million shares outstanding to about 155 million shares outstanding. That's fantastic. They've done it sort of chunk, a little bit every year. They haven't done anything crazy. Good years they buy a little more, bad years they buy a little less, but basically every year they've taken some money and they bought back shares. And another thing that you got to think about when they buy back shares is it's a tax advantage and tax-free way of creating money for the shareholders. You pay taxes when you get dividends, but you don't pay taxes when you own a larger percentage of the company, and thus in theory get larger dividends and larger earnings in future years. So let's look at the ramifications from SEI's buying back stock over the last 10 years. So in 2009, if you'd bought 10% of the shares in the company, you would have owned 19.021 million shares of stock. Through stock repurchases, your 19 million shares today would mean your ownership in the company has gone from 10% of the company to 12.5% of the company. So you now would own 25% more of the company than you did 10 years ago, and you would have done that with no further investment on your own. Looked at another way, your share of the company's earnings would have gone from $23 million to $63 million, so they would have tripled in that time frame. And breaking that down, that has gone from $1.22 per share to $3.31 per share. So we're buying stock in a company whose earnings are going up, and that's a good thing. But in addition to the earnings going up, we're getting ever larger percentages of the earnings as the company buys back stock, and we're getting those ever larger percentages without ever investing another penny and without paying taxes for the benefit. So buying back shares is an important tool management uses, and SEI does a very good job of that and has created real wealth for the shareholders through doing this. Another thing that I look at in the wealth creation is shareholders' equity. So shareholders' equity is simply the total assets the company has minus the total debts. And in theory, the company will trade in some relationship to its shareholders' equity, some multiple of shareholders' equity. You like to see that number going up every year. It just means the company's getting bigger and getting stronger and getting healthier as time goes on. And you can see this company in 2000 had shareholders' equity of about $200 million. Today, it has shareholders' equity of about just under $1.8 billion. That's pretty good, and it's done that pretty much every year. And by the way, it even managed to do that through the recession. You know, most stocks that I look at, I always say, look, ignore what happened between 2007 and 2010 because that was the recession and things were really bad. But this company's shareholders' equity really did do pretty well even in that time frame. So yet another vote of confidence for SEI. One of the biggest things that I look for, and I talk about this in all my videos, is return on assets. The reason return on assets is so important to me is that there's an old saying, you need money to make money, and that's true, but what you really want to know is that you need some money to make a lot of money. You don't want to have lots of money making a little money. So return on assets is simply what is the total amount of money that this company has tied up in their assets, and how productive are those assets? And the higher that number is, the better it is. That means that I don't mind if this company wants to retain earnings because they historically use those earnings very, very efficiently. It means that I don't mind if this company is not paying me dividends, and I don't mind if this company is not buying back shares because they seem to be using the money very efficiently. Warren Buffett is fantastic at return on assets. So it's a key issue for me, and if you look at this company, it is head and shoulders above most of the other companies. You know, the red line, 10%, is what the top 10% of the 1,000 companies that I've looked at earn in terms of return on assets, and these guys are, 2 and 3 times that. I mean, it's spectacular. When I say this is one of the highest rated companies that I've looked at, it's one of the highest rated companies I looked at just overall in all of the categories. But one of the things that makes it so intriguing to me is it's also very, very strong in the areas about which I care the most. So return on assets for this company is, spectacular. This kind of return on assets is the kind of thing that would almost make me buy a stock no matter what. And it's also the kind of thing that makes it very hard for me to justify selling a stock, because I just figure they're going to do a great job holding my money and continue to earn money with my money. So this is the strongest vote of confidence I can give to a stock. So return on shareholders' equity is sort of the same thing and sort of not the same thing at all as return on assets. So shareholders' equity obviously is the total amount of assets minus the total amount of debt. The problem here is that return on shareholders' equity rewards companies disproportionately who have too much debt. If you have too much debt, you have very little equity. And then if you're in a little bit of profit, you get a fantastic return on equity because you didn't have any equity. The thing about this company is that it virtually has no debt. I think it has $50 million in debt or something. And so the fact is their return on equity is really the same thing as their return on assets. And for them to be in the top 10% of companies when the other companies have the additional advantage of throwing on a bunch of debt, it makes this company even more special. So this company is, again, return on equity, return on assets, rebuying shares, very, very strong in all three categories. This is a chart of retained earnings. So retained earnings is kind of the idea that you have to reinvest some money in your business to keep it going. Every business needs some money to keep going. And so what you reinvest in the business is just sort of the cost of ongoing operations. What you like to see is a company that doesn't require a lot of retained earnings, because the more retained earnings they have, that reduces the amount of money they can use to pay dividends and to buy back shares and to do all the things that we like as shareholders. It's just money that is basically, once you earn it, it's still gone off the top. So the lower the retained earnings, the better. And then the next slide we're going to talk about, which is return on retained earnings, looks at how efficiently those earnings are being used. Now, again, I say this every time so people understand it. The way I calculate this is not really very scientific, because there's not necessarily a direct result between the two, but in the long term it adds up. And here's the way I do it. I take the total amount of retained earnings a company had for 10 years. And then I say, okay, that's how much the money needed to stay in operations, but how productive was that money? So then I just take the amount of increase in earnings over the last 10 years. So I take the total amount of retained earnings and I take the total amount of profits that the company made. I say, how much did the profits go up? And I say, 100% of those profits are the result of retained earnings. I realize that that's not actually the case, but what I'm trying to do is just figure out, for every dollar you retain, how are we doing in terms of additional profits? And this company, again, is spectacular. I look at anything over 10% return on retained earnings as being very, very investable. And this company is over 100%. So for every dollar they keep in retained earnings, they throw me $1 of additional profit. I mean, I would love them to retain all of their profits if they could do that. So again, this company is spectacular in this category. I'm not sure if this company isn't the best of the 1,000 companies that I've looked at in this category. Another thing that I like to look at is cash and debt. You can see the debt is zero, but I like to look at them in relation to each other. And I do it more so for companies that have debt, so I can figure out how easy would it be for the company to pay off the debt if they had to, and what's the company's ability to borrow money in bad times. We're going through this coronavirus right now, and you'd like to have reserves and the ability to borrow money if you needed it. So this company is about $800 million in debt. It's gone up, but it's going up relatively gradually. So they actually have more money than I would like them to have in terms of cash, but I recognize they're probably waiting for rainy days and they're going to do the right thing when the time comes. I have so much confidence in this company's management that I am in no way concerned that they have $800 million. I'm going to talk about that in the next slide, which is interest expense and income. You can see that the red line is interest income. So they've got that $800 million and it's actually making us some money. It's not making us a lot of money. They made about $17 million on $800 million of cash, so it's probably 2 or 3%. But the point is they have no interest expense, and that money, that $800 million, is making us something. And again, I'm willing to accept that the company, because they do great with returned earnings, and they're getting some money off the cash they're holding, and the cash isn't going up as fast as earnings, I'm willing to just give them a pass on this and say, fine, keep the money. I'm sure we'll get it eventually. So this is a great chart. This chart is total wealth created. So the orange line is the wealth that's been created over the last 5 years. Now, I measure wealth created by looking at several categories. First, any change in debt. If we can reduce the debt that the company has, then that's a creation of wealth, right? We now have lower debt and the same amount of equity, so the company should be worth more. If it goes the other way, I look at that as a negative against wealth created. I look at dividends. Dividends are money that are paid directly to us. That's obviously wealth. I look at net stock buyback. So if they're buying back shares, I'm owning a larger percentage of the company. And so I look at that as wealth that's created by us. I look at an increase in cash as wealth that's created by us, especially if they're able to pay dividends, buy back stock, and pay down debt, and still have an increase in cash. That's a really strong indication that this company is managing the company well. Now, I don't want to see too much cash cap because I want the money to come back to us. But an increase in cash is weaponry the company can use in bad times. They can use it for acquisitions. They can pay us dividends later, et cetera, et cetera. So an increase in cash, I look at as part of increasing wealth. You add that all up, and that comes up to the blue line, which is wealth created annually. And then the orange line is wealth created over the last 5 years. And you can see this company has been very, very positive, really going back to 2009 at the recession in terms of every year creating additional wealth for the shareholders and creating significant wealth. Last year they created about $350 million worth of wealth for the shareholders. So this is a very, very good company. They're doing an excellent job in every measure of wealth creation. I didn't talk about dividends. We've got another video coming up where I talk about dividends. But in terms of wealth creation, there's just no area this company falls short. And it's one of the strongest reasons why it's the best company I've reviewed and why I can suggest you can buy it without hesitation, even in today's market, maybe even especially in today's market. As I've said in the past, I've been watching this company for 3 years waiting for a buying opportunity, and I finally got it. So this is the slide that I don't want to show people. This is how our performance is year to date. Gilead, we sold. We made our profit on that. We made about a 16% return on investment on that over about 167 days. So it was a great investment. Very, very happy with that. Literally everything else we bought is down. The coronavirus is killing my portfolio. I think it's killing everybody's portfolio. I'm not even sure it's worth talking about right now other than to admit that I'm down 30%. And I'm highly confident my stocks are going to come back. I haven't sold anything. I'm not going to sell anything. I may rebalance the portfolio a little bit, but let's put it this way. I will not have increased my net cash position. I'm going to be fully invested because I really believe that this market's going to come back pretty strongly, and we're going to get all of our losses back and maybe some profit. We'll see. Anyways, thank you for watching this video about SEIC. Please remember to subscribe. Please remember to like all the same stuff everybody says on the videos. Thanks.